How do you lower a high T ratio to get loans? Imagine trying to buy your first car or even a home someday. One thing lenders look at is your debt-to-income ratio. If it's too high, getting approved can be tough. So, how can you bring that number down? Let's break it down. Your debt-to-income ratio is found by dividing your total monthly debt payments by your gross monthly income and then multiplying by 100. For example, if you make $5,000 a month and pay $1,000 toward debts, your T is 20%. Lenders usually want this number to be 36% or less. If it's over 49%, it's a red flag for them. Student loans are part of this calculation because your monthly student loan payment counts as debt. Even if you're managing other debts well, a high student loan payment can push your T higher. To lower your T, start by paying off smaller debts first. If you have credit cards or loans with small balances, paying them off completely removes those payments from your ratio. It's a quick win. Another option is to switch to an income-driven repayment plan if you have federal student loans. These plans can reduce your monthly payment to 10 or 20% of your discretionary income. This directly lowers your T and can make qualifying for loans easier. Increasing your income is another way, though it's more challenging as a student. You could look for a higher-paying job, ask for a raise, or take on extra hours. If side income is steady for at least 2 years, lenders might consider it when you apply for a loan. Paying down your overall debt is also effective. Focus on reducing what you owe, and your T will improve even if your income stays the same. Refinancing your student loans to a longer term can lower your monthly payments, which helps your ratio. Just remember, longer terms might cost more in interest over time. Budgeting and cutting unnecessary expenses can free up money to pay down debt faster. Avoid taking on new debt, especially large purchases, because every new payment increases your T. If you're applying with a co-borrower who has a lower T, that can help balance things out. Lenders also look at other factors like your credit score, payment history, and savings. Building good credit habits now, like paying bills on time and keeping credit card balances low, creates positive factors that can offset a higher T. As a student, managing your student loans responsibly while keeping your ratio in check is smart. Every dollar you put toward debt now helps you qualify for bigger loans later. The key is combining debt repayment, income management, and smart financial choices. Starting these habits early will set you up for success when you're ready for larger purchases or a mortgage.